Hello, this is Steve Coker, president of Cedarstone Advisors, and this is the April edition of Cedarstone Economic Insights. The Federal Reserve has been in the news over the past few weeks, most notably because on March 18th, the Federal Reserve changed the language of their outlook, potentially opening the door for a rate hike this year. And as a result, some pundits are calling for a sell-off in the market. In this month's Economic Insights, we want to dig into the question, how soon to the first Fed rate hike? And secondly, does it really matter? Really trying to answer the question, is the market heading for a fall? For the past year, in fact for the past 6 years, stocks have trended relentlessly higher with only minor interruptions. And every time that the Fed hints at a change in policy, the market gets jitters and we've seen a pullback. Last year, those brief stock market corrections were mostly tied to the Federal Reserve's talk of, quote, taper, the winding down of quantitative easing, or their QE program. But since last October, the jitters have been tied to talk of the Fed's first rate hike. And in March, we saw a brief pullback as investors bet that the positive job data will pull forward the initial interest rate hike to as early as June. I think it's worth pointing out, however, that while stocks have briefly stuttered at the Fed's periodic mention of tightening, stock market investors have quickly moved right back into buying mode on signs of growing momentum in the economic data. That's why here at Cedarstone we say that economic fundamentals are really in the driver's seat. So what is this Federal Reserve looking at and what are they doing? The Federal Reserve has a dual mandate: full unemployment and controlled inflation, currently targeted at 2%. So let's take a look at the first goal, full employment, on the top chart on this page. The chart shows unemployment trends since 2004 for both U3, which is the most commonly quoted unemployment figure, and U6, which is a broader measure which includes the underemployed and is the measure that the Fed is paying more attention to at this point. The trend in both measures of unemployment has been favorable. However, even given the recent trend, it would take until late 2016 before we reach something that the Fed would call full employment, implying that the Fed is likely to remain patient. Further, the Fed's dual mandate calls for low inflation, currently targeted at 2%. So inflation is shown on the bottom chart with actual in red and the Fed's forecast in black. You can see that actual inflation has been running far below 2%, in fact under 1% year over year in December, and well below the Fed's own forecast. As a result, the Fed has plenty of room not to raise its target rate so as to maintain monetary stimulus in order to keep driving unemployment back down, again implying that the Fed is likely to remain patient. So how long until the first rate hikes? We may in fact see a rate hike this year, but it will likely be modest at best, and we believe that further rate hikes will be limited. So let's take a look at the assertion that if the Fed raises the Fed funds rate, that it'll kick off a bear market. Historically, initial Fed funds rate hikes have caused the stock market to stutter. But following the initial stutter, stocks have continued higher even as the Fed has repeatedly hiked rates. This chart shows the S&P 500 over the past 33 years, shown in black, and the Fed funds rate is shown in red. The beginning of the rate hike cycle is circled, and in each case you can see that the initial rate hike has been followed by a prolonged rally lasting several years. Could it be different this time? Yes, but I do think that many pundits in the media are implying that the rate hike is a signal of a bear market, and that simply has not historically been the case. The reason for the delay is that the Fed's actions take a while to work through the economy, but also it's important to understand what exactly the Fed is doing and how the Fed's actions impact the economy. When the Fed raises the Fed funds rate, the Fed is raising short-term rates for banks, not long-term rates that consumers typically see. Lenders, banks and non-banks, tend to borrow short and lend long. Hence, as the Fed raises short-term rates and their cost of funds rise compared to the interest rate that they earn on loans, banks can curtail their lending activity, and that puts a damper on the economy. Therefore, it's really the difference between short-term rates and long-term rates that matter most. Today, we have a steeply positive yield curve. shown in red on this chart, meaning that short-term rates are low and longer-term rates are higher, making lending profitable. When short-term rates rise to the point that we have a flat or inverted yield curve, like we did in 2007, shown in black on this chart, then banks curtail lending because it becomes unprofitable. Even with an initial rate hike by the Fed, we would anticipate that the yield curve will remain positive for an extended period of time. This is the key policy lever that the Fed has to act as a governor on the economy and keep inflation from getting out of hand. If you want to learn more about how this works, I recommend that you take a look at How the Economic Machine Works video by Ray Dalio on our website. It gives a more in-depth explanation of how the Fed really impacts the economy. The bottom line, even if the Fed does begin raising rates this year, we will still have a steep yield curve which points to accommodative policy, a condition that is likely to continue well into 2016. Economic factors continue to be in the driver's seat, and as long as the economy continues to improve, stocks are likely to grind higher.